Yeah, good day everyone. This is going to be like an all-encompassing introduction to the forex market or the financial asset market. Well, there are some aspects which I already touched about on the synthetic indices, but this one is actually a general one. So I'd like you all to pay attention. The video may be a bit long, but this is all you need. Or this is like a summary of what you have on babypeeps.com. Now, in this course, at first, technical analysis shall be taught. It is later the much more on fundamentals shall be like be taught to you guys. Wow, look at this, illiquidity. So definitely um price mistake. Oh, sorry about that. Anyways, so that's yeah. So I'm going to be introducing the forex market and every other introductory part to you guys. So the forex market is the largest financial market in the world because on a daily basis, an average of $5.3 trillion is traded worldwide, or between $5 to $6 trillion daily, not listing. So you can see that there is so much to be made from this market. The total daily liquidity is $5.3 trillion. So everyone can always have a share. And the sweet thing about this is that if more people are coming in, the daily liquidity keeps on increasing. It doesn't mean that one person is going to drop, or that it keeps on improving. So now, what is traded on the forex market? The forex market is the same as foreign exchange market. So it is not like maybe it's an over-the-counter market. So you get now. So the forex market is a little bit slightly different from the crypto market, in the sense that um in the sense that yeah, so it's a little bit different from the it's a little bit different from the crypto market, which has a market capitalization um of around less than 2 trillion, for at least for now. Definitely is going to improve. But in the forex market, the New York Stock Exchange alone is worth about 26 trillion market cap. So you can imagine how big the forex market is. So now, um, we trade currencies or currency pairs on in the forex market. We trade stocks, we trade commodities, stocks like company stocks like Facebook, Apple, Microsoft, Tesla, commodities like oil, gold, silver, um, CFD indices like the um, Nasdaq Q, US 30, um, Dow Jones, and what have you, DJ and what have you. So um, there are so many things you can, like so many instruments you can trade in the forex market. Now we move on to what a forex broker. Now a forex broker are like firms that gives you access to the forex markets. Like they provide you access to the financial markets in the sense that they give you what they call leverage. Now, ordinarily before in the 90s, we ordinary people like us couldn't trade the financial market or the forex market because we didn't have enough money to actually trade the markets because of it was meant for either the top banks, central banks, or the really or very, very influential and rich guys. It was not until the 2000 that the forex brokers came up with that, and um they like bridge the gap between the rich, the mighty gap between the rich and the poor. And this is like an easy avenue for, for an ordinary person to actually make a lot of money and then live a good life. Definitely after mastering this the trading. But right now, so um they provide they pull our orders together and then make it like, you know, a big one and take it to the financial. Although I don't have enough idea about how a brokerage firm runs their dealings, but um don't let me stress myself on that. So we have different types of brokers: hot forex, FXTM, FXCM, FBS, light forex, XNS, XM, and what have you. So we have so much or so many like that. So now we'll move on to I'm trying to outline all of this because I have it here and I don't want to miss a thing. So we move on to the sessions. Now the forex market is open 24/7 for 5 days, or the 5 working days, which is Monday to Friday. But the problem is that, okay, it's not a problem, it's not a big deal. We have five sections of in the forex market, in the sense that the first one is the Sydney section, which represents the Oceania region financial session. We all know, or if you can check, we know that Australia, New Zealand, and the Oceania countries are way ahead in terms of time than every other cities or every other nations, most nations. So they are up earlier than us. In the sense, they are up earlier than us. Like they start their daily activities earlier than us. So that is why the Sydney session is the first session, and it opens around 9 p.m. GMT. So that is GMT. Nigerian time is GMT plus one. So you just add a you just add a you add 1 hour to whatever time you have here. Although in order not to confuse you guys, I'm going to an app that you can download on Play Store. This is for Android users. It's called FX Hours. FX Hours. So sorry, it sets the time like automatically for you, and then you like have a like you said the time for you. So every session lasts for 9 hours. So if Sydney session open by 9 p.m. GMT, if it's open by 9 p.m. GMT, then it will close by 6 a.m. GMT. If Tokyo session is the next one. We have Sydney session, Tokyo session. Sydney is the capital city of Australia. Tokyo is the capital city of Japan, which also represents the Asia session. That one opens by 11 p.m. GMT. So you know what to do with that. 9 hours opening every session. So you add 9 hours to that. Then the London session opens by 7 a.m. GMT. You add plus one, and they add 9 hours to it. Then the New York session opens by 12 p.m. GMT. So you add 9 hours to that. So like I said, every session lasts for 9 hours. That's when every session lasts for. Now it's important to note that in order to like have a good trade, although some people prefer session by session, maybe some people prefer Asia session, some people prefer London session, prefer New York session. Now it's important that you understand that it's best if two sessions are open. And I'm going to explain the scenario to you guys in the sense that, for instance, you want to trade euro against USD now. It is best for you to, euro now is the uniform currency for European countries, apart from the Great Britain. Yeah, apart from the Great Britain. So you get GBP is the Great Britain pounds is the currency for the Great Britain, while USD is the currency for the United States. So if um the London session opens by 7 a.m. GMT and um the New York session opens by 12 p.m. GMT, so definitely, if for trades or currency exchanges, would actually be more to exchange euros USD would actually be more when the New York session is open. Although this is not fixed, but it's actually logical enough. So you get now. So they call it when they are actually overlapping, when two sections are overlapping, as there will be more volatility, and volatility means money. So we have different terminologies used in the Forex market. I'm coming. To go long means to buy, to go short means to sell. Bulls means the buyers, bears means the sellers. I'm sure you guys must have known from crypto or something. A ranging market is when there is no clear trend, or where the market does not have a clear direction it's moving. While a trending market is a market that has direction, which would either be up or down. For instance, this now is a downtrend, although this is 1 hour time frame, doesn't mean anything, but this is a downtrend, then this now is an uptrend. So that is that about that. So a bullish market is a market that is going up. So we can say that this is a bullish market, this going up, while we can say that this is a bearish market. Please, this is 1 hour time frame, it doesn't mean 18. All right, so that is that. So we have NFP. NFP is non-farm payroll news. So it is released every first Friday of the month. Every first Friday of the month. So it is released by the US Feds. So some nicknames of currencies. The pound is not the cable, dollar greenback. Well, that is not actually important. So, all right, forms of trading. We have fundamental analysis and technical analysis. Fundamental analysis, which was what I made mention of, that deals with news that as we go on, are going to be taught that. Then technical analysis actually means using price action, technical indicators, and what have you. But majorly, what we are going to be taught here is technical analysis on price action. I don't actually use indicators. I used to use it before, but I literally don't know how to use it, or I have little or no idea of how to use it anymore. All right. So personally, I don't trade the NFP. I swing trade in the Forex market. So it's actually doesn't matter, but at least if I'm swing trading, definitely if I'm holding a trade for a month, that's not more swing trade, that is position trading. So definitely if I'm swing trading, what I mean by that is more than a day, maybe a week maximum. So that's what I'm holding my trade for. So, or less, definitely. So now the NFP is a news that contains various data and statistics released by the US Bureau of Labor and Statistics. Anyways, all those gibberish. So it is released every first Friday of the month, like I said, and 12:30 p.m. GMT and also 1:30 p.m. Nigerian time. So this is when it is released. It actually creates a lot of volatility because of, this is like an indicator of how well the US economy grew over the past month. Yes, like an indicator of how the US economy grew over the past month. So what is contained in the NFP news? The non-farm payroll increase. When they say non-farm payroll, what this means is that excluding the farms or the agricultural sector probably. So the data includes the manufacturing sector, the unemployment rates, the sector of the economy that jobs were mostly added, and the average hourly earnings of the workers in the US. Did it increase? Did it reduce? Then also lastly, a revision of the previous NFP news. So definitely if the news is positive, then this shows a sign of that the US economy is going. If the unemployment rate drops, definitely that's a sign of increase. But if the unemployment rate increases, definitely that is maybe a sign that maybe the economy is not growing. And also sectors of the economy that grew, this gives investors ideas of the sector of the economy they can actually like invest their money into. So that is that about that. Now, um, currency pairs. We have different currency pairs. Um, we have different currency pairs. So, oh, coming. Okay, yeah, I have it here. Don't worry. So, we have different currency pairs. We have um the Euro USD, GBP USD, um, and what have you. Now we have different types of currency pairs. We have the major currency pairs, mostly the ones paired with the US dollar, and mostly the ones in which the like mostly the ones that their currencies for those sections I mentioned, like the Sydney section now, the Aussie dollar, which is AUD against USD, that is a major currency. USD JPY, that is a major currency. Euro JPY to an extent, Euro USD, GBP USD, those New Zealand USD, and New Zealand dollar USD, those are major currency pairs. We have the exotic pairs, such as those ones that I don't trade them. I trade majorly the major currency pairs. So now I'm going to be saying some things. Now this is um the base currency. For instance, now you want to buy Euro USD. Euro is the base currency, and USD is the quote currency. What does this mean? It means that, like for instance, these are the price here. I'm going to talk about this price here. What this means is that how much of this would you have to hold, the USD, the quote currency, do you have to hold to purchase one of the euros? So here now it says you need to have 1.172425 in order to get 1 euros. You need 1.1726 to get 1 euros, because we know that euro has a much more value than dollar. So you get now. So it's now saying how much of the quote currency you need to purchase the base currency. All right now. So sorry. So that is that about that. So I'm going to talk about people. I don't want to miss anything. because I have them here and you must have seen them everywhere, but I'm just trying to, brush through this stuff. So a peep is like one of the most important thing you just have to like understand in this market. One of the is the bedrock of the market, because we are all of us are chasing pips. Either we are chasing pips or we are avoiding pips. Chasing pips in the sense that for our take profit, avoiding pips in the sense of for our stop losses. All right. So um a pip is the smallest unit in which a currency pair can change. So I'm still concerned about the definition. All right now. So you must have seen that in this place now we have I've ignored the superscript up here. We are concerned about these four decimal numbers at the back of this. So we have 1.1726. Definitely the Euro USD is any most of the Euro USD has four decimal numbers at the back. Now USD JPY, the JPY pairs, Japanese yen pairs have two at the back, so that's two decimal. Okay, the gold, as you can see, has two decimal two. These all of them have different ways in which their pips are calculated. I'm going to start with the easiest, which is um Euro USD. It is just a basic stuff. So now, for instance, we have 1.1725. Let's peg it at 1.1725 for the Euro USD. So we now say they stay okay, 10 pips. You have a stop loss or take profit of 10 pips. So you just add 10 to the back. So that is 1.1725 plus 1.1735. So your TP, your SL will be at, let's say you want to buy. If you want to buy, your TP will be at 1.1735. If you want to sell, if your SL will be at, what am I saying? Sorry. So let's say you have a take profit of 1.1725. Sorry, you have a take profit of 20 pips and your stop loss is 5 pips. So what do you want to buy? So you just add 20 pips to 1.1725. That was 1.1745. And you subtract 1.1725 minus 5 for your SL. That will be 1.1720. So that was going to be your pips. Like you must have heard that, oh, you missed my entry by 1 pip. It means my stop loss by it mitigated my stop loss by 1 pip and so many other stuff like that. So that is what they mean. So this one is a 4 decimal. All right now. So we move to the JPY pairs. All right. All right. So here now we have 109.38. So the Japanese pairs. So you just all right. So you just add, for instance, if it is the 10 pips, you just add 10 to it. So it will be 109.48. If it is 5 pips, 109.2.33. So that is it. Then we move to gold. I want to rush because definitely I expect everyone should have first-hand knowledge, but it is important I do this. So let's say for gold now, it's actually very, very different. Very, very different. So gold is actually a decimal. Is actually a decimal. All right. So it's actually a decimal in the sense that if price should move by 2 pips, if price move by 2 pips, so it will be 1762.226. The gold decimal is 0.1, just one. So that will be 1762.2. If it is 10 pips, 1763. So that is okay, that's dropped again, 1763. So you actually 176, it was 1763 before. So let's say 1763.50, and then you have a 5 pip stop loss. You subtract 0.05 from it. That's the way I'm going to solve the 0.05 from it, because it is just one decimal. For the Euro USD, which I said was 4 decimal, if you're having a 40 pips stop loss or TP, you just maybe your 1.1150 now. You just subtract 0.0040. If it is 100 pips, it will be 0.0100, because it is 100 times 0.0001, which is the 4 decimal. Here now it is just 1 decimal. So that will be, if it is 100 pips, it will be 1762.00 times 0.1 times 100. That is what 10. You add 10 to this 1762. That will be what? 1772. So that's your 100 pips in gold. If it is 1762 plus maybe 200 pips, gold moves very fast. It moves a lot. So 172 plus 200. So that would be 1762 plus 0.1 times 200. That's 20. So you add it to it. 1762.20 plus 20. That's what? 1782. So please take note of those things I just said now. The major currency pairs paired with USD, apart from the JPY pairs, have 4 decimals, and the JPY pairs have 2 decimals, while gold has just 1. All right. So now we move to the bid and the ask price. The bid price, this is the bid. Let me move to currency, please. The bid and the ask price. I'm coming in. The bid and the ask price. Now, this is the bid price, this is the ask price. Now, the bid price is the price buyers are willing to buy, while the ask price is the price sellers are willing to sell. Because if you want to buy something, you want to buy it at a cheaper rate, while you want to sell it for profit, definitely. Oftentimes, the ask price, not even oftentimes, the ask price is always more than the bid price. Like I said, bid price is the price buyers want to buy. Buy price is the ask price is the price sellers want to sell. Definitely, if you place a buy order at a market buy order, you are going to get triggered at this ask price, because that's the price sellers want to sell. If you place a sell order, you want to sell, you place a sell order, this is the price. The bid price is what they are ready to buy. So it's as simple as that. So now what is the spread? This is the spread here. This thing here is the spread. This 0.1 here is the spread. Now, spread is the difference between the bid and the ask price. That you can see here now. You see this super subscript here now. If it increases again, you see that it's going to increase. So bid is the difference between the bid and the ask price. So it is the ask price minus the bid price. Now be careful with your spread because imagine now you want to buy and sellers are willing to sell at an higher price for you. So you get now, I avoid brokers that their spreads are really, really high because it's affecting your trading. Sometimes you set an order now, price will not get to where it's supposed to, or price will like go below your order, and then you are noticing that it did not trigger, maybe a limit order, it didn't trigger because of spread. Price didn't actually get, because that was not the price they were willing to sell to you. So you now be like, but price mitigated where I set my order at, and then it was effect of spread. So please take note. Now we have take profit and stop loss. Now this is very, very important, especially the stop loss. The stop loss is very, very important. So I'm going to start with take profit. Take profit is like an order given to your broker that, okay, you should close or lock this trade, close the trade for you in profit. That, okay, if you should get here, then let me close the trade and then return automatically. Your money will be like returned to you, like your profit and your money will be returned to you. So you get now. Then the stop loss is actually an order that you tell your broker that, okay, if price should go to get to this point, let me close the trade, and then your loss, your calculated risk or loss will be deducted, and then your money, the remaining money will be left to you. Now, we have different scenarios for buying and for selling. Now, for instance, coming. I'm coming on. Okay. All right. So, like I said, buy and sell scenario is different. So here now we have buying at, let's say, 1.1880, 1.1800, sorry, and then our stop loss is at 1.7935. Like I said, you just subtract it. So that will be 1.1800 minus 1.1793. So that was around 7 pips stop loss, and then our take profit is at take profit is at 1.1863603. That's like 60 pips take profit. So you get now. Although you have to manage your trades and all of that, probably maybe there's a point that's going to be validated, but this is how you do it. For a buy scenario, your stop loss will be below and your take profit will be above. So now we cannot know how much you're going to make, because what determines the amount you're going to make is your lot size, and the amount you're going to lose is your lot size. So we don't have that yet. I just needed to show you that, okay, this is how you place your buy and sell. So the stop loss for the sell. If it was a sell, maybe you sold from here and you want to take profit. Your take profit will be below, and then your SL will be above. So that is that. All right. And also note that if you want to buy, you buy it is the ask price that will be sold to you. If you want to sell, it is the bid price that will be bought, that you will buy. It's simultaneous stuff. All right. So all right. So all right, lot size. Lot size is like is the amount of quantity of a trade that you bought or sold. In the sense that, like I said at the beginning of the video, that we are not supposed to be trading with the little money we have. Even if you have $10,000, it's still small normally. If you have 100,000, it's still small on a normal basis. So you get millions was traded prior to now. So the lot size is like the amount, like I said, the amount of quantity that of trade you bought or sold. Now, I'm not going to bore you about the meaning. So let me just get straight to the point. We have standard lot size, a mini lot size, and micro lot size. Now, standard lot size means you're buying, for instance, now we have this Euro USD now. You are buying 100,000 units of this Euro USD. If you want to sell, you are selling 100,000 units of it. It is represented by 1.0 on the MetaTrader, 1.0 lot size. That is the standard lot. That's the standard lot. So if you are buying 10, if you are using 10 lots, that means that you are actually buying 1 million of quantity of this Euro USD. Mini lot is 10,000 units, which is represented by 0.1. If you are buying or selling, maybe you want to buy 5 mini lots, that would be what? 0.5. That is 50,000 units. If you want to buy 9 mini lots, 0.9. So when you get to 1.0, that is a standard lot again. Micro lots, these are the 1,000 units, from 1,000 to 9,000 units, represented by 0.01. So 5 micro lots is actually 0.05. So you get now. Now, standard lot size, 1 pip. You are using a standard lot. Let's say, okay, for instance, now we bought yen at this, we sold yen now 1.18603, and our 1.1860, ignore the decimal at the point. It's when you want to calculate your profit or SL that we include it. So let's say we sold at 1.18603, and we're using a standard lot of 1. So that what this means is that, and our stop loss is at 1.1869. So what this means is that, or let me just say 1.1870. So that was like 10 pips stop loss. So what this means is that if one lot size or one standard lot represent $10 per pip, what this means is that 10 pip is actually $100. So you are risking $100 on this trade. If you are using one lot size. If you want to calculate your TP, it will actually be 10 times 60, because 1.1860 minus 1.1800 is what? 60 pips. So that was what? 60 times 10, that's 600. So you actually making 600 while risking 100. What this means is that if price should get to this point here, you're going to be losing $100. If price should get here, you're going to be making $600. So the same thing for the buy scenario, just that stop loss will be below. Now, if it is a mini lot size, that is, let's say you're using one mini lot size, that is what? 0.1. So what this means is that for the mini lot size, $1, 1 pip represents $1. So what this means is that in this trade, 1.180, 10 pips, that would be what? 1 times 10. So that was $10 risk. So if you are using 5 mini lot size, that is what $5 times 10, that was $50. It is from 10,000 mini lots to 90,000. So that was from 0.1 to 0.9. So, and your TP will be at, if you're using 1 mini lot, that would be what you'll be making $60. All right, now, so if you are using micro lots, so that is what 1 pip is $0.1. So in this case now, it will be 0.1 times 10 for your SL. So that was what 1. The pips or TP will be at 0.1 times 60. That was what 60 times $6. So it depends on your account size. Your account size and your risk appetite determines what you'll be risking, and then your lot size. All this should be calculated before you use. Don't just jump because you saw someone making 1 million, 10,000 in a day, 17,000. You start trying to use your $100 account. Don't do that. You can actually, but learn well first. So leverage is like one of the benefits that the forex broker gives you. Sorry about that. So like the leverage is like one of the so back to leverage, we have different types of leverage in which the broker provides for you. So some of it includes 1:50 leverage, 1:100, 1:1000 leverage in which they provide for you. Now, types of orders or type of market orders. Now I'm going to just be teaching you the ones in which I know. We have 3 types. We have the market execution limit order, as well as the stop order. Now, the instant market execution means that, for instance, now at this point here, price is at, when euro US is at 1.1723. It means you want to buy it at the current market price. So if you place a buy order now, it's going to activate at the current market order. That is for market order. Now, for the limit order, we have 2 types. It could either be buy limit order or sell limit order. Now, buy limit order means that you want to buy at a price lower than the current market price. Maybe you want to buy at this point here, 1.16653. You set a buy limit order below price at a later period. So if price should come here, maybe it goes up, it's not going to activate until when price comes down back to this point here. So that's a buy limit order. A sell limit order is when you want to buy above price. I'm sorry, when you want to sell above price. So let's say you want to sell at this region here. You are going to have to wait for price. It's only going to activate when it gets to this point here. Now, that is for buy and sell limit. Now, you stop order now. The buy stop order is actually one in which you want to buy above price. So let's say you want to buy at this point here now. So it's going to activate, the buy stop order will activate at this point. The sell stop order is when you want to buy and sell below price. So maybe you want to sell at this point, you want to sell from here. So this is where you are going to sell from. So oftentimes I use mostly the sell limit and the buy limit order, in the sense that because of you want to buy at support, or you want to buy at support or demand zone, and not buy at supply. So that's why a limit order is actually the one I use the most. And then you want to sell at resistance, so definitely sell at sell limit. So I use the limit orders the most, oftentimes, if not every time. Or the market order, maybe I want to like just catch a move. So that is what, or join a move that already happened. Maybe I came in late or something. So that is what I use. What do we have again? Confirming